Dividend growth investing. One of many strategies on how to make money in the stock market. Personally, it's my favorite. It's a very common strategy amongst a lot of investors, and today I'm going to explain it to you. So I'm the Gen Z investor. Welcome to my channel. Subscribe if you like what you see. On this channel, I talk about personal finance, investing, and I track my overall investing growth. Today we're talking about dividend growth investing. This is the stock market strategy that I personally use. It's very common. A lot of people use it. A lot of people like it for many reasons. So today I'm going to explain what it is, go through it, and give you an example about why I do it, and an example of stocks that fit into this strategy and a stock that doesn't fit into this strategy. So let's get started. The dictionary, textbook definition of dividend growth investing is as follows. Building a collection of shares in great companies that increase their dividends every year at a rate that is the same or better than inflation. That is the key to dividend growth investing right there. We want these dividends from these companies to increase each year, usually more than inflation. The whole point of this is so that each year we're making more money than when the year before. If we invest in companies that don't increase their dividend because of inflation, we're actually losing money each year. So that's step one in dividend growth investing. Every year you want those dividends to increase. You want the dividend payment to go up. You want the company share to go up. You want a combination of both. Holding onto positions for long periods of time, often decades, to take advantage of deferred taxes, as it allows more capital to be working for you and more dividends pumped out for your family. In essence, all this is saying is reinvest the dividends, let the power of compounding grow over time, don't cash out. You're also deferring taxes because you aren't selling the shares, so you're not paying that capital gains tax and those commission fees each year. You're just buying once, usually for a horizon at least 5 years and on, and you just want to collect those dividends, let those dividends grow over time, and keep collecting those paychecks every quarter, every 6 months. So essentially that's it. There's more. You can obviously, it talks about diversifying across different industries and sectors. That's always important, but that's a whole nother video. But just to keep it very simple, dividend growth investing is investing in companies that increase their dividend each year. Next, I'm going to show you an example in the Canadian financial economy. Two companies where one of them fits into my portfolio that I personally own. Again, this is just for entertainment purposes, this video. I'm not telling you to purchase a stock, not purchase a stock. You have to make those decisions on your own. But I'm just showing you examples of what kind of companies fit into a dividend growth investing strategy compared to others. So I'm going to show you here. So these two companies I'm showing you are TELUS and Rogers. These are two major telecommunications companies within Canada. So these two companies are somewhat similar with the things they do in operations in business, yet TELUS fits into my dividend growth portfolio while Rogers does not. So let me show you here. So TELUS, as you can see, TELUS, ticker symbol T, trades on the Canadian Stock Exchange. On the right hand side, you can see the list of their past dividend payments. So starting at the bottom on the right hand side, you see April 1st, 2016. 44 cents a share. Then, 3 months later, 46 cents a share. Goes up 2 months in a row. Then, 48 cents, 49, 50, 52, 54, 56, and so on to today. That is exactly what dividend growth investing is. Those dividends are increasing at a rate faster than inflation each year. So, just for buying this, if you bought the same stock and you received your first dividend payment on April 1st, 2016, you would have collected 44 cents. The same same dividend payment, not interest, 3 years later for that exact same stock you haven't sold is now 54.5 cents. That is exactly what you want in a dividend growth stock. You want those dividends to increase. TELUS, for example, increased their dividend, as you can tell, every 6 months. So they do smaller increase, about 2 to 4% every 6 months, which if you combine the two increases in the same calendar year, leads to an average increase of 7 to 10% on their dividend each year. That's outstanding. That's exactly what you want for these type of companies. Inflation in Canada over these years ranges from 2 to 3% per year. So having that dividend increase of 7%, you're having a net raise of at least 4% on your money, which is great, along with the capital appreciation of the stock, as you can see from the price from the stock price history from Google. So that's exactly what you want. TELUS is a very large part of my portfolio. I really love this company. I don't believe it's going anywhere in the next 5, 10, 15 years. One more thing I want to point out before I show you the company that does not fit into my dividend growth portfolio is look at the market cap of TELUS. $30 billion. That's the size of the company. The next company I'm going to show you is Rogers. Rogers, same sector as TELUS, is a telecommunication company within Canada. Look at the market cap of Rogers before I go into it. $33 billion. So almost extremely similar. They're the same size company, operate in the same sector. Bunch of different reasons. There's obviously a bunch of different things that makes them different. But now we're going to show you their dividend history. Look on the right-hand side here. April 1st, 2015. Dividend of 48 cents a share. Next year, 48 cents a share. The year after, 48 cents a share. And 2018, 48 cents a share. 4 straight years with no increases to their dividend. For me, that makes this stock not a member of my portfolio. Although it's similar market cap, similar price and price growth over the last 5 years, the problem is this company does not increase their dividend each year. They have a lower payout ratio than TELUS, which is a payout ratio is another aspect you have to look into in determining if a dividend is safe and sustainable over time. But that's a whole different story. What I just want to show you guys and focus on to see what stocks can fit into your portfolio for this method, there's no increases here. So that means the lack of increase, keeping the same payment each year, means you're actually receiving less of a dividend each year. Because of inflation, this 48 cents that you're receiving on April 1st, 2015 is worth a lot less than the 48 cents you're receiving April 3rd, 2018, 3 full years later. So that is something you have to look into when doing this. It's a very important aspect. So you have to look for those companies if you want to be a dividend growth investor that increase their dividend each year. I'm not knocking Rogers. Rogers is a great company. They have great price performance over the last 5 years. Their stock has been increasing in value. There's a lot of good things about Rogers. But if you want to be a dividend growth investor, if you want to build a portfolio around that strategy, you're a long-term investor who seeks the income to grow each year, then TELUS, for me, would not fit into that portfolio. Others, it might for any other reason, but for me, it doesn't. So that's just why I don't have it in my portfolio. Soon I will be updating you again. You will see another update on my portfolio. Hopefully I can get a little closer to achieving my goals. Thank you for tuning in. That is what dividend growth investing is. Hope you enjoyed the video. Look forward to seeing you next time. Thanks.